the Gould Mine podcast.
Okay, so that actually kind of answers my question, right? Because I thought in my research, maybe I was a little mistaken, because I thought that you had gone from single families. You're like, hey, I'm going to do some of my own multifamily deals, and then you started investing as an LP. So it sounds like the primarily as a sole investor, you've mostly focused on single families. And then once you went over to the fund/syndication space, that's when you started touching the larger, like, apartment type style assets. That's
right. Yeah. So the progression was, my own assets, investing as a limited partner, and then transitioning to general partner. And I do think it's very valuable to first invest in a lot of these deals to kind of see how they work. Right?
Yeah.
You learn a lot about the structure, best practices, and what's working, what isn't, how you can resonate best with your investors. So I think there was a lot of value. If I had just jumped in as a GP without having invested in deals, I wouldn't have as much frame of reference. So I think it was a good transition to be an investor in these deals for a number of years before I got involved as a GP. It gave me a lot of context.
Yeah, that makes a lot of sense. Now, having seen lots of these deals from an LP and now as a GP, I'm curious what your take is on some of the advantages and maybe potential drawbacks of having like a fully integrated, fully vertically integrated syndication and or fund, right? Like what are some of the benefits? What are some of the potential drawbacks of that vertical integration?
Well, there's certainly benefits. Drawbacks, I'm not sure there would be as many. So, I mean, that's one of the most important elements of a project, right? Is who's managing that property day to day. So oftentimes somebody buys a property, maybe it's got a lot of potential, but if they can't deploy the right third party management, there's risk there, right? And the management company isn't going to be as motivated, right, as the owners are. So we have the same incentives, right? The guy who's got the property management company is part of our ownership team. He's going to be very focused on it. Plus, he's got a great track record in the metro. I mean, if you look at his whole portfolio, not just our properties, but he manages all kinds of other properties. He's typically at 96% occupied, very few evictions, very, very few delinquencies. So he's just applying his very successful model to our properties, and he's got the same alignment of interest, right? So I think it's a really key differentiation because, these properties are going to get paid attention to. So not that you can't successfully syndicate when you don't have property management in-house, but I think it's a big advantage, right? For those reasons.
Yeah, absolutely. It makes a lot of sense. And one of the, I guess the potential drawbacks that I've always just kind of thought about is having everything managed by that one team could be a huge advantage because economies of scale, cost savings, all that good stuff. But then drawbacks are, if they screw the pooch in one area, they might screw you know what I'm saying? So you're kind of putting all your eggs in one basket. And so that's always like a potential drawback. And so again, to your point, even more reason to like vet the sponsor, really make sure that you understand who, for lack of a better word, who you're getting into bed with, right?
That's right. Yeah. So it's worked well for us so far. So I think we want to continue this approach, right? So there's not one way to skin the cat. I mean, most people don't have a property management resource on their team, so they got to outsource it. It's very common. Some of the bigger groups have ultimately after a few years, they sometimes bring property management in-house, right? They create their own group for property management if they've got enough properties. And I've seen big groups do that, sometimes successfully, sometimes not, right? Property management is not an easy business. So it's kind of labor intensive and customer service oriented. And so it's very different skill sets that they're involved. So I wouldn't want to be a property management personally. So I'm really glad that we've got the resource that we do already in place.
I wanted to come back to risk adjusted returns. And so I think this is a great time to do that. I'm curious because I think we all understand, well, maybe we don't all understand, but say the majority of the listeners here understand some of the basic return metrics, right? Cash flows, so cash on cash, IRR, equity multiplier, all that good stuff.
Yes.
How do you measure those again? Like, risk-adjusted returns. How do you quantify risk? What are some of the things that you look at in order to quantify that and then measure that against the projected returns of the deal?
Good question. It's very hard to succinctly quantify it, but I would say this. I think based on the type of project, you just have to kind of evaluate the execution risk involved. Mm-hmm. So as I was mentioning, some of our more recent projects and some of what I was buying myself, right, are new builds, right? So if you buy a new build, your main risk is lease up, right? You just got to fill the units, right? That's a risk. But you're not going to add value. You're not going to rehab units. So that risk is taken off the table. You don't have to raise rents. Usually your model isn't going to be, you got to rehab and raise rents to $300 a unit, right? Because those things might be hard to pull off, right? Maybe rents in that market aren't going to support it. Maybe rehabbing a unit is going to cost you more than you think. So there's a lot of risk involved, not only development, but in heavy value add type projects. So if you buy a new product, for instance, your risk inherently is much less because it's a new unit. You just got to lease it up. It's going to be appealing because a renter would most likely rather live in a new unit versus some older unit, right? So because it's lower risk, maybe you can accept a lower return. Maybe I'm okay with it. 13, 14% IRR because it's new product. You're not going to have deferred maintenance. There's a lot of risks it doesn't have. But if I invest in another project, it's got value add, you got to raise rents, there's more uncertainty there. I should expect a higher return because there's more risk, right? So maybe I should expect 17, 18% return IRR because, bigger risk, bigger upside. So there's definitely more risk. And then if it's a development project, I would also submit where there's not, it's a piece of land and I haven't built anything and it's got to go through all these phases and happen. You probably are going to need another step up in projected IRR in order to accept that risk, maybe over 20%, right? So that's how I look at it, right? And so there's, the big institutions, sometimes they want to buy very low risk commercial assets. So they buy like a core plus, and that means it's a fairly new product, stabilized. They just buy it and hold it, right? It's almost new. There's not going to be a lot of maintenance. They're not going to value add. So sometimes that's what they're looking for because that's their appetite. They have a very low appetite for risk. And they're willing to accept a lower cash on cash and a lower IRR because there's a lot less things that can go wrong, right? They're in a good metro, kind of a new product. Just plug and play, right? So that's what I was getting to with risk-adjusted return. Each project has its own profile, and the more execution risk that's involved, the more projected, the higher projected returns should be because that's to accept more risk. You need to be able to profit higher if everything goes as planned. So, and everybody as an investor has got to figure out where they're at and like how much risk they're willing to tolerate. And in somebody's portfolio, maybe there's room for each of these types of assets, but in order to have diversification. But people should understand that, sometimes you see these returns touted for all these deals, but somebody that's new to this might say, oh, this is a new development project. It's going to give me 22% IRR. Here's another project. It's going to give me 12%. Why would I possibly pick 12%? Well, that's a number in a spreadsheet and you have to determine, a lot of things going to happen in 5 years. And so how risky is it? What's the probability something could go wrong? And there's got to be, a corollary between your risk and your potential reward, right? So hopefully that kind of lays it all a bit, right? How I think about things.